Inflation continues to be a concern that appears to be exhibited in rising yields at the long end of the U.S. Treasury curve. Those are concerns that Jay Powell and company set to allay this week, saying they're still targeting above 2% inflation, not as a forecast, but to see it for real, Jay Powell said yesterday. And he is not worried about the Fed's ability to contain inflation. Stephen Poloz is with us now, former head of the Bank of Canada, governor of the Bank of Canada, and special advisor to Osler, Hoskin Harcourt. Thanks so much for being with us, Governor. We appreciate it. And I want to start with the suggestion that I saw somebody make today, which I thought was an interesting one, which is we're asking monetary policy to solve a problem it didn't create. And in part, there are numerous elements to that. But is there something fair about that there's a fiscal piece here that monetary policy now has to kind of get its arms around?
Well, there's no question that fiscal policy is one of the most important ingredients in any economic forecast, including that for the central bank. So, having that incorporated in your outlook, and if it was sufficient fiscal expansion to bring you all the way back to an equilibration between demand and supply, well, then that would probably mean over time interest rates would be a little higher than they would be if fiscal hadn't been as big as it was. That, I think, is unambiguously a positive thing because we all think really low interest rates are not that healthy for the economy.
So when you see what's happening in the long end of the yield curve, if you were Jay Powell, if you were sitting at the Fed, what else can you do to reassure markets that you are aware of the potential for inflation, but that you're not worried about it?
Well, I mean, first of all, it's a very delicate situation. So I don't like to second guess what Jay might be trying to do. But what I would say is that you should be thinking about where would the 10-year be if everything were back to normal. If everything were back to normal, I guess I'd expect it to be something like 3% on the 10-year. 1% for economic growth, maybe a bit more, and 2% for inflation, firmly held expectations. Well, we're far from that. So I don't really see what's going on in the bond market today as inflation fears. Rather, it's a symptom of success that the economy is actually on track and likely to become even more on track. And as we go, as we go forward, we're going to find that the economy gets on track faster than originally thought. And the bond market is telling us that they're convinced now that that will be the case.
So then let me flip it around, because if anything, our experience with super low rates, and we've seen this, obviously the one example we use is Japan, and there's all kinds of reasons people will say Japan's not a good example. It's very different, but we're still going to use Japan as an example. And we can also look at the Eurozone, where it almost feels as though you start, as they say, pushing on a string. You can't get inflation back once you've gone past a certain point. Are we in any danger of that, do you think, in North America?
Well, in theory, we are in danger of that because we have all the ingredients here to have, the second Great Depression, but except for the fiscal expansion that is underway. That is the key difference, and that's the most important thing that's going to prevent that. If it kickstarts the economy, which I have every reason to think it is, in fact, the faster the U.S. economy gets back on track, the faster the fiscal action takes hold, the less structural damage there will be in the economy. And what we're talking about is supply side damage, scarring and all that, which means a permanent effect on the economy. The faster we go, the less of that there will be. So I think there's a lot to be said for this policy. And like I said, if it turns out that interest rates are half a point higher than they otherwise would be, that's a good thing because it means less expansionary speculation, maybe less heat in the housing market and that sort of thing. So a more balanced kind of economy.
I know this was something on your mind as central bank governor. It's been on the minds of Western bank governors, and that is that kind of permanent setback, the capacity that's lost forever. Because we have had this amazing fiscal input here in Canada and the U.S., have we avoided the worst case scenario there in your view? I mean, I know it's something we can only know retroactively, but do you feel good about the trajectory we're on?
I feel very good about it, and I think we have done a pretty good job. Afterwards, you never say it's perfect, but in the heat of the action, I think it was extremely well done. And I think what that means then is that the economy will, every time it gets opened up again, right? We take the restrictions off, it bounces right back. And so most of the damage or the people who have lost their jobs or businesses that are under threat, most of them are in sectors that are used to high turnover, such as restaurants and small retail. And so the bounce back was very impressive that we saw in the fall. And I think we're going to see it again this spring, especially as the vaccinations gradually build momentum. So that just shows the underlying economy is actually quite healthy. When we started all this, unemployment was at a 40-year low. Inflation was right on target. You can't be in a better place to have a shock.
We're obviously been preoccupied with the so-called K-shape. Through this pandemic, we've seen, these whole sectors that unfortunately have a concentration of certain types of workers that have just been shut down. Can we say that we'll get as close to, a one-to-one reopening of those sectors as one could hope post-recession? In other words, if you lost your job because your travel-related business closed down, it will reopen and you'll get your job back, and the economy will snap back in those sectors fairly strongly.
Yeah, the idea from the beginning was to be as if we stopped the clock on the economy, and then after a time we restarted. The second wave meant that we had to do it twice, and we may have some more shutdowns perhaps in a third wave, but so far so good. But that doesn't mean that there are no permanent effects. So, for example, what we're doing right now means I think there'll be less business travel in the future. More Zooming and WebExing, et cetera. And I think in addition, there's probably going to be a little less shopping in in-person retail. Mind you, in that sector, there's always somebody who always wanted to open a little shop, so the entrepreneurial spirit is alive and well. We created a lot of new businesses all during the worst part of the pandemic. So we know that spirit is under there. I think the main thing is central banks are going to have to probe the economy and let it run and not be over anxious about inflation. My sense of this is that we can go quite a ways without citing exciting inflation pressures, and that'll be the supply side of the economy growing faster than their models suggest.
One of the things central bankers have had to do for some time now is be a little insouciant about the asset price increases caused by low rates. And we've seen that obviously work its way through stock markets. I think we can now say speculative level in certain places, and we can debate where they are. But the Canadian housing market is one that we hear more and more is just fueled by low rates for a long time. And more importantly, I guess, even the expectation that rates never go up. That this is a whole generation of buyers who just have no concept of rates going up and home prices falling at the same time. Right. Is there some policy, and lots of action's been taken, is there something else that could happen other than rates naturally rising at some point and home prices coming down?
Well, first of all, rates are already naturally rising. And I think what we're going to see is that the bond market will lead the central banks up in due course. We might have a really steep curve for a while. But that's going to begin to hit the sort of typical 5-year mortgages in due course. Short-term interest rates may stay low for a really long time. But in the background, I think if that's why we cut interest rates. We cut interest rates in order to boost the economy. Well, if we're not going to have a hot housing market, we won't have any reaction at all to that. And so that's all part of the side effect of the job that you're there to do. If the side effect is a hot housing market, that's one I'll take every day. We have really good rules around mortgage lending, and we have excellent banks that know what they're doing. And so in the end, that mortgage loan is between the borrower and the lender. And I have a lot of confidence in that underwriting process. So my sense of this is, yes, it's hot. We could see signs of speculation, but we have to accept that because otherwise we would have, a really, really bad recession.